Good afternoon, everyone. Thank you for your support. I know that lunch is delicious outside, but thanks for still turning up. It's a great pleasure to be here. I would like to actually start my session with a question, so a quiz. Can you make a guess? Over the last 5 years, what is the average earning volatility of the container shipping sector? I have 3 options for you: 30%, 50%, or 80%. Any guess? Most of the room actually said 80%, and you're spot on. I don't think it's a surprise. And this chart really tells the whole story. I would like to focus your attention. Oh, what happened to the slide? Can I have the slide back? Thank you. I would like to focus your attention on the dark blue lines here, which is really the global container freight rates over the last decades or more. I think it goes sideways, up, down, back up again, and down again. This is a very definition of volatility that has been driving earnings and performance in the sector. And I think over the last 2 days, we've heard a lot about the different forces at play, whether it's a US tariff, whether it's a regulatory changes in the sector, whether it's the large order book expecting to come over the coming years. There's a lot of different forces that may be pulling up and down the rates again. So if we all boil down to one statement, I would say volatility is here to remain. And that volatility has also been driving value in the sector. So I've selected two of the largest container shipping players, Hapag-Lloyd and Maersk, and look at the share price performance over the recent past. And you can see that the share price has been moving in lockstep with the freight rates. So when the freight rates goes up, value goes up, and when the freight rates goes down, the value follow. Does that mean that there's not much control in terms of value creation in the sector? Well, I'll say I have good news for you. So over the past few years, I probably would say since 2022, 2023, there has been a flurry of completed and announced acquisitions by the container shipping players into terminals, ports, and logistic businesses. I think if you look at the statistics since 2020 until now, 58% of these acquisitions are in the logistics space. Maybe some examples like Hapag-Lloyd since 2023 until now, they built up a platform of about 21 terminals. Maersk led a dozen of acquisition into the logistics space. Now, because of all of these acquisition and investment, we've noticed one trend. There has been a consistent positive correlation between valuation multiple and how much investments these firms are making. So which is a left-hand side chart here. We look at EV to EBITDA multiples across the container shipping players, as well as how much investment is being made at a percentage of cash flow. And there's been that positive relationship. So I think there's new hope. Investment can be a catalyst for value in the sector. So apart from value uplift, is there any other benefit to these investment? Has really investment, it made any payoff? Let's have a look at earning volatility, which, could relate to my first questions. Let me break it down to you. This chart shows you EBITDA volatility of the biggest container shipping players. We look at the big alliances here. So you can see 8 names. The bar charts, blue, lighter blue and darker blue, represent earning volatility in 2 different periods. Sorry if I'm blocking the screen. The dark blue is representing earning volatility in the last 5 years, and the lighter blue bars is over the last 2 years. And then we have these lines, the horizontal line, which represent the freight rates volatility in these corresponding periods. 2 observations. Number 1, the sector is highly volatile, as you guessed, 83% to be exact is the average volatility in earnings over the last 5 years. That has come down quite significantly for most of the players that we looked at. But what is more interesting is really this shaded green area. We identified there are 3 out of the 8 players that we highlighted here managed to actually break away from the freight rate volatility. So their earning volatility over the last 2 years is actually much lower than the container freight rates. What is the common theme here? Now, Interestingly, these three names have also been the ones that made the most investment into this whole logistic move that I mentioned at the beginning. Are you convinced? Let's look at another parameter. So we look at asset beta. So asset beta is a measure of how an underlying business is sensitive to systemic risk. We run through the whole share price performance of these container shipping sector and compare them to the S&P 500 market basket. So in this right-hand side chart, the dotted yellow line represents the average asset beta for container shipping over the last 10 years. And then we also plotted for Hapag-Lloyd and Maersk, which is two out of the three names that I mentioned earlier that managed to break away from this volatility of the freight rates. What we've noticed is, number one, overall asset beta has come down in the recent years. No surprise, because we also saw volatility in earnings came down. But Hapag-Lloyd and Maersk, their asset beta is consistently lower than the sector asset beta. So there is some argument there saying that if you continue to diversify, perhaps your sensitivity to systemic risk will come down. We tested that hypothesis in other sectors as well, which I have a little chart here on the left-hand side for you. So we look at a few sectors. Sorry if it's blocking, but basically oil and gas. We notice that asset beta for integrated oil and gas players is lower than the ones who only focus on upstream. We look at metal and mining. The diversified metal and mining players have significantly lower asset beta compared to the single metal one. And if you look back at the container shipping sector, which we have a bigger chart here, 1.51 is the asset beta, the most recent asset beta for container shipping. And that is significantly higher if you were to compare with the logistics sector asset beta, which is 0.67. I think arguably, diversification does really play a role in bringing more stability, whether it's earnings or whether it's sensitivity to the external environment. So I think we've established that investment is a great thing. It created value uplift, it has provided more stability. Is there capacity to do further investment in this sector? I guess, again, no surprise to you, I've heard a lot about excess liquidity, excess balance sheet capacity over the last 2 days. And let me just throw it out, another statistic for you. On average, the container shipping sectors hold 4.3 times more liquidity than they need for their BAU, so for business as usual need. And we've done this forecast. So on this chart, the gray bars represent what the broker consensus is in terms of the liquidity requirement for the medium term for these different players. So that incorporates any shortfall whenever your cash flow from operation cannot support your capex or cannot support your dividends or your debt maturity. And we also incorporate the working capital fluctuation in the sector. And that represents the needs, which is a gray bar. But the actual liquidity, which is the blue bars on the right-hand side, and that's broken down in different types of liquidity, whether it's cash, short-term investment, or undrawn RCF, that is significantly higher than the needs. Everybody is holding a lot more liquidity than they need in one form or another. 4.3 times is the average for the sector. And if you look 5 years ago, that coverage ratio was only 0.9 times. How about on the debt side? So there are only 3 out of the few names that we look at are rated. There was also one of the few, the biggest one, Hapag-Lloyd, Maersk, as well as, you can't really see that, but that's CGM, CMA CGM. Just these 3 names collectively has $48 billion excess debt capacity on their balance sheet. If they were to raise up to $48 billion, they are still within their rating triggers. That's a lot of capacity exists. And I'm sure if you were to have the opportunity to look name by name for many other container shipping companies, the story would not be so different. So what do we have? Everybody is investing. Investment has paid off. There's a lot of capacity to invest. But then what does it mean for the sector? I think the acquisition and investment trend will continue because there's a really strong rationale for it, whether it's for diversification, whether it's for securing strategic geographical location, whether it's about capacity and security assurance, whether it's about cost efficiency. But what it means is, as container shippings are making these investments, they are evolving in terms of the business model. They are becoming integrated logistic powerhouses. And what it means is, as you have a new business model or evolving business model, your financial policy and your capital structure cannot be static. You really need to rethink the shape and the size of your balance sheet. What is the stack of the funding that you're going to have for the long term? So there are a few things that we think of, whether it's, it's earning volatility that I mentioned. So if you expect for earning volatility to go lower over time as you transform as a business, that means you can afford to hold a little bit less liquidity, start still being prudent, but not inefficient. And perhaps there would be more appetite for leverage, for example, as earning volatility reduces. One example is this chart on the left here. I wanted to demonstrate to you. So you have two clusters of players. You have the container shipping players. These are the bubbles in blue. And you have the pure logistic players, which is the like of FedEx, UPS, DHL, etc., which are the green bubbles. This is measured in 2 dimensions. We look at the relationship of the earning volatility, so EBITDA volatility of these players versus the liquidity that they hold. There is a very simple relationship. The more volatile your earning is, the more liquidity you should hold. Now, as container shipping is migrating towards that left side of the chart where you expect earning volatility to go down because diversification is helping, perhaps time to rethink the liquidity because you don't need so much. And as your earning volatility is less, you can actually afford to operate closer to your optimal leverage, where perhaps you can use a bit more tactical leverage into your balance sheet without really impacting the resilience of the business. So I hope that I've left you with some food for thoughts. This is only for the container shipping sector. I've thrown a lot of numbers, of charts, colors at you. But if you were to go away today, I would like you to remember 4 things. Number 1, there's a huge transformation happening in the sector. And the container shipping players are transforming into integrated logistic players via this acquisition. And this acquisition and investment overall has paid off in value and in stability. And there's a lot of balance sheet capacity, whether in liquidity or in debt measure, to support further investment. But as these investments are happening, business models is evolving, and therefore financial policy and capital structure need to be reconsidered and recalibrated, and we're here to help. 1 minute of shameless advertisement. So we are a team within Standard Chartered. We look at across different sectors, not just in shipping, and we do a lot of, we look at the whole holistic balance sheet strategy and capital structure for a lot of clients across the sector. So I lead for the region here for South and Southeast Asia. If you're interested, even if you're not container shipping business, please come to us. We'll be more than happy to help. Thank you for your time.